So respond. If you're not writing anything, don't waste time. You are better off telling Mwalimu, no, I know nothing about this farm valuation. Please go ahead and do the question yourself. So I'm waiting to hear from you. Given that they are not chatting with me, chances are these students know exactly what is to be done. Mwalimu says, Mwalimu, go ahead and do it. Mwalimu, go ahead and do it. Go ahead and do it. The same also from Samuel. Thank you very much. Now, ladies and gentlemen, remember that whenever it comes to valuation of organizations, the most important thing is for you to know how, first of all, we need to calculate the cash flow arising out of what here? Infinity. The first working here will be the infinity cash flow. So we have here infinity cash flow. Please don't forget that our major topic is mergers and acquisitions. Mergers and acquisitions. Now we are looking at, under mergers, what we call the corporate valuation. Before I acquire a company, it will be very important for me to attach a value to it. Otherwise, I'll be shooting in darkness. I will be going into this exercise blindly, which is dangerous, disastrous. So first of all, give us the infinity cash flow. If you remember, this infinity cash flow, we normally use the provincial officer approach. The infinity cash flow, we normally use the provincial officer approach. Anytime they talk of infinity, always think about provincial officer. Provincial officer. Provincial officer, ladies and gentlemen, if you can remember this concept of provincial officer, we normally talk of district officer who has to grow all over Kenya minus government. All over Kenya minus government. All over Kenya minus government. Provincial officer is the current market price per share. O means current. O means current. O means current. DO. DO is the current dividend per share. The current dividend per share. And then we have 1 plus the growth rate all over our cost of equity or cost of capital minus growth rate like that. Minus growth rate like that. So anytime we talk of infinity cash flow, always think of how you can make use of this formula. Very, very important for us. Now, ladies and gentlemen, if that is the case, look at this infinity cash flow. DO is the most current dividend. This will be the most current cash flow to this. 18 is the most current. So we have here 18 into 1 plus the growth rate. You can see growth rate G is 0.04. The growth rate G is 0.04 all over cost of equity. Here we are given cost of capital as 10%. So cost of capital is 0.1 minus 0.04. Please give me an answer there. Please give me an answer here. Please give me an answer. Give me an answer. Give us an answer. Give us an answer. Josam and Bernard, they're giving me 300 and what here? 312 like that. Now I no longer need to have this thing here being blank. What I need to do is to come and delete this, and then we write 300 and what here? 12. That is how we calculate the cash flow, which are infinity in nature. Cash flows that are infinity in nature, we must always remember this provincial officer formula, which comes from the cost of capital, specifically how to value shares. How to value shares. How to value shares. Thank you, and thank you very much. Now, ladies and gentlemen, having gotten this 312, now we are at a very good position of coming here and writing PVIF. PVIF at the cost of capital given, which is 10%. Remember, PVIF stands for present value interest factor. PVIF stands for present value interest factor. Now, could you kindly help mwalimu. Could you kindly help mwalimu? Which formula of PVIF, which formula of discounting factors am I going to make use of here? Remember, whenever it comes to discounting cash flows, I have got two types of cash flows. I have got two types of cash flows. These cash flows are like this. We have what we call the regular versus irregular. Regular cash flows are those cash flows, ladies and gentlemen, that are uniform. Today you get 10, tomorrow you get 10, the other day you get 10, etc. Irregular are like now the ones that we have here. The ones that we have here, ladies and gentlemen, happens to be what here? The ones that we have here, ladies and gentlemen, happens to be fluctuating. They are different. They are irregular. And for irregular, remember, we normally discount these using the PVIF. PVIF whose formula is 1 plus R raised to what here, somebody? Raised to negative N. So if it is irregular like these ones are irregular, they're irregular, we shall talk of 1 plus R raised to negative N. Thank you very much. I can see Lucy Naisanya already has gotten something. Ladies and gentlemen, because these are irregular, as Lucy has told us, this is the formula we shall use. So I'm using this formula. Nitakuja hapa niseme 1.1. Kila mali niseme 1.1. 1.1 because of what here? Because our R, cost of capital, is 10%. And 10% is the same as 0.1. So therefore, this will be 1.1. So raised to the number of years. So this will be raised to negative 1, raised to negative 2, number of years, raised to negative 3. And please never ever forget that the discounting factor that you have up here is normally the discounting factor we use for infinity. There is no even good reason for us to write anything there. The discounting factor that we have here will be the discounting factor that we will be putting down here. Great. So I'm waiting to get these answers from yourselves. 1.1 raised to negative 1. If I could go to your charts, I'll be able to get those answers very fast. I can see 0.90, 0.9091, if I'm not wrong, 0.9091, and then I can see 0.8264, 0.8264, and then I can see 0. I can see here 0.8264, 0.7513, 0.7513. This 0.7513 is the one that I borrow down here. It will be 0.7513 like that. For infinity, never take this to be 4, year 4, no. For infinity, remember we have been able to discount whatever we have here up to the end of year 3. For infinity, this is how you cram it. For infinity, ladies and gentlemen, ensure that for infinity, the discounting factor you have up here is the same discounting factor we'll be having down here. So, ladies and gentlemen, having appreciated that, I would want you to go a step further to give us these figures. So come and create a column for present value, and if possible, present values, please give us present values in terms of 2 decimal places. The first one, according to Lucy, we are getting 9.09. 9.09. Now, ladies and gentlemen, remember what I told you the other day. If you want to get maximum satisfaction out of an online class, ensure that you dive deep into the class by giving us answers, even if they are wrong. You simply type, and then you contribute. Even if they are wrong, it doesn't matter. So long as you're giving answers, then you will be able to connect deeply onto whatever we are doing. Otherwise, if you take a sit back kind of approach where other people are giving you figures and you are just synthesizing, no. You'll not be able to derive maximum benefits out of an online class. Remember, the physical classes at times could be advantageous, because in the physical classes, you could be having like a neighbor next year. If you're not able to understand this bad teacher, your neighbor can be a good teacher for you, But here now, we happen to be, here now, Here now, we happen to be in a situation where you don't have a neighbor. So your only neighbor is your mwalimu. However bad it could be, I'm now your neighbor. So and the only way you can connect with your good neighbor here is to ensure that you give us answers throughout. So we are being given the second figure, 15 times 0.8264. The second figure is 13 point. It is a 12.4. It is a 12.4 somewhere. There is a 12.4 somewhere. And then there is a 13.52. There's a 13.52. And then lastly, ladies and gentlemen, we happen to be having this big figure of infinity, which happens to be what? Which happens to be 234, 234, 234.41. And then I'll come and add for you to be able to give us the total present value. Add for you to give us the total present value, of which I can see Samuel Oyunge and Maalim giving us two, and also Lucy giving us 269, 269.42. 269.42 is the total present value. Remember, whenever you're doing farm valuation, you don't subtract anything. Whenever you're doing farm valuation, we don't subtract the initial outlay, because here the objective is not about ascertainment of NPV. No, the objective is not about ascertainment of NPV. It's not about ascertainment of what here? NPV. Now, ladies and gentlemen, this happens to be the total value of RCM. Having known that this is the total value of RCM at the very beginning, it becomes very easy for you to know the figure that you're going to sit with these people on the bargaining table. So when I go to the bargaining table, I know there is no way I'll be able to pay more than that amount. I know there is no way I'll be able to pay more than that amount. Now, ladies and gentlemen, I'm suspecting these people may easily give you a mergers and acquisitions, but the valuation case context, valuation case. And whenever they give us valuation questions, they don't throw their stone very far away from this question that was brought in May 2016. Question number 4, boy. May 2016, question number 4, boy. May 2016, question number 4, boy. Anytime they give us a question on corporate valuation for purposes of mergers and acquisitions, this is the kind of style, right, that they normally bring the questions to us. So May 2016, question number 4. May 2016, question number 4. Have we gotten that question? Have we gotten that question? Even saying yes adds a lot of value for online classes. Just yes. Because it's all about connection. How are we connecting? Page number 134. Yes, for those of you who happens to be having these revision kits, RCM revision kits, you simply go to page number 134. Yes. So they're telling us something very easy there. They're telling us Huge Limited intends to take over a company called Tiny Limited. So Huge Limited intends to buy Tiny Limited, another company in the same industry. Tiny Limited is expected to post earnings of shillings 86 million next year. So please underline for me 86 million. Underline for me 86 million next year. If Huge Limited acquires Tiny Limited, the expected results of Tiny Limited for the next years will be as follows. It will be very important for you for purposes of corporate valuation to monitor the trends of the companies you want to buy. Look at the sales, look at the expenses, analyze the profitability, get the cash flows. It is these cash flows that you shall be able to use to attach a firm value. So you can see here we have the sales there, we have expenses, we have the capital allowances. Capital allowances in finance represent what we call depreciation. Could you kindly write there into brackets, capital allowance, depreciation. Depreciation. And then, ladies and gentlemen, we have the interest there. The interest there. And then we happen to be having cash to replace assets and finance what here? Finance growth. Cash to replace assets and finance growth. Now, ladies and gentlemen, we are told from year 4 onwards, it is expected that the annual cash flows from Tiny Limited will increase by 4% each year into perpetuity. I must underline that thing. 4% each year into perpetuity. Into perpetuity, that is something that I have to underline. If UG Limited acquires Tiny Limited, tax is payable at the rate of 30%, and this tax is paid in the same year the profits to which it relates are earned. Thank you. If UG Limited acquires Tiny Limited, it estimates that the gearing after the acquisition will be 35%, measured as the value of debt as a proportion of the total equity. Ladies and gentlemen, whenever you see the gearing percentage, what normally comes into your mind? Whenever you see the gearing percentage, what comes into your mind? For my case, whenever I hear gearing, I always think about debt. And to be very specific, gearing percentage is also known as the weight of debt. If I were you, I would have written that statement somewhere in my mother tongue, that gearing percentage, yes, I can see what Mary has told me, financed by debts. I can see what Samuel has also told me, that whenever I hear this word gearing, I know gearing means debt, specifically weight of debt. So if weight of debt is 35% in this question, what do you think shall the weight of equity be equal to? The weight of equity, if weight of debt is 35%, what do you think, ladies and gentlemen, will the weight of equity be equal to? In this particular case, from what Mary and from what Maalim and Eva Mararo, thank you very much, Eva, for coming here. We have Caroline. They got this correct. They have told us that if weight of debt is 35%, then weight of equity is 65% or 0.65. Thank you, and thank you very much. After the acquisition of Tiny Limited, UG Limited would have a cost of debt of 7.4% before tax and a beta of 1.60. So, ladies and gentlemen, whenever you see beta being given, what should you think about? Whenever you see beta being given, what should we think about? CAPM. Actually, even from the way you guys are explaining these things, the way you are able to release them very fast in this case here, they're at your fingertips. I think I'm even wasting time being with you here this night, because you guys, it's like you passed this paper long time ago. It's like you passed this paper long time ago. So whenever you see beta, ladies and gentlemen, beta, CAPM's formula has to apply somewhere. So could you kindly do me a favor, if that is the case? Could you kindly do me a favor? Write CAPM's formula. Write CAPM's formula somewhere there. Just get your own ingenious way of writing. Get brackets. Even if they are not there, I'll be able to understand. I'll be able to understand exactly what you are saying. CAPM equals. Yeah, I can see what Jadida has done. She's told us that CAPM equals risk-free plus open brackets ERM minus risk-free into beta what here? Beta equity. Thank you, and thank you very much. What this good lady of ours here, and Rania as well, what they have told us is that the CAPM, whenever I'm given beta, I must apply CAPM. That CAPM returns or CAPM cost of equity. In this case, we are talking of cost of equity. CAPM cost of equity will be equal to risk-free plus we have ERM minus risk-free multiplied by beta what here? Beta equity. Multiplied by beta equity. The risk-free has been given. The return on the market portfolio has also been given. Now, unfortunately, ladies and gentlemen, again, you will get some students after after they see CAPM like ourselves here, they even start doing the CAPM calculations very fast, because CAPM is very easy, very fast, without having a look at the requirement. The requirement number one, they want us to give them the offer price for tiny limited, if huge limited were to value tiny limited on a forward price earnings multiple of 8 times. If we're to value this organization using the PE ratio, ladies and gentlemen, using the PE ratio valuation, using the PE ratio valuation, using the PE ratio valuation, I know that PE ratio from these, it is market price per share all over EPS, all over EPS. And then remember that for farm valuation, we would want to get the market price per share. We want to get the market price per share. So the market price per share here will be equal to the PE ratio, times who? Times EPS. Make MPS the subject of the formula. If you make MPS the subject of the formula, you'll be able to see that it is PE ratio times EPS. Now, ladies and gentlemen, for us here, they want the total market value of a farm. They want the total market value. They want the total market value of a farm, So then this one will be equal to PE ratio times total earnings, PE ratio times total earnings will be equal to PE ratio times total earnings. Will be equal to PE ratio times total earnings. Why? Because now here I've taken into consideration all the number of ordinary shares that there are to get the total market value. I've taken MPS times number of ordinary shares, So I'll take PE ratio times the total earnings, because even this has now to be multiplied with number of shares. So that we talk of totality. So if we talk of totality, ladies and gentlemen, really, what do we have here? I've been given the PE ratio to work with. The PE ratio to work with in the required, they want us to give them the total offer price for tiny limited, if huge limited were to value tiny limited on a forward price earnings multiple of 8 times. So it is 8 times the total earnings, which we are thinking that we shall get ourselves. The total earnings were given up there at the beginning in paragraph number 1. In paragraph number 1, huge limited intends to take over tiny limited, another company in the same industry. Tiny limited is expected to post earnings of 86 next year. So times 86. Thank you very much. So then could you kindly, thank you very much, Pamela. So what is 8 times 86? 8 times 86 gives me what value? From Samuel, we are getting 688. 688. So ladies and gentlemen, using the PE ratio model, there is no way I will be able to pay more than 600 what here? 88. 688 million becomes the maximum amount payable. I don't know whether we are clear up to there. Is there anybody who would want Mwalimu to repeat something, or are we okay? Pinjenga says, perfect. Thank you, and thank you very much. How about the other students? Are we okay up to there? Yes, Susan says no. Together. No. Okay, great. Now let me repeat this. This is quite a simple thing. How do we normally get PE ratio? How do we normally get PE ratio? Assuming that an organization has got market price per share of 20 and the EPS of say 10. EPS of 10. Ladies and gentlemen, our PE ratio will be equal to MPS over what year? Over EPS. Market price per share all over earnings per what year? Earnings per share. Earnings per share all over earnings per share. So in that case here, I will come and talk over 20 all over what year? 10. 20 all over 10. Now listen and listen to me very well. Of course, this will give me tubo. Now, ladies and gentlemen, listen and listen to me very well. What if we had number of ordinary shares of the company being given to us as 100? If number of ordinary shares are given to us as 100, then to get the total market capital, to get the total value, total market value, I will take the market price per share times number of ordinary shares. So it will be 20 times 100. So 20 times 100, this will give me 2,000 like that, which will be the same as the total earnings, same procedure for total earnings. How will we get the total earnings? I'll take earnings per share times number of ordinary shares, times number of ordinary shares. So 10 times 100, this will give me 1,000. And that is why we are saying that this PE ratio, in terms of totality, the PE ratio will be equal to total market value all over total what year? Total earnings. Total market value all over total earnings. So you could either decide to work with figures on a per share basis or totality. So the total market value is 2,000 all over total earnings of 1,000, which will end up giving us the same 2 like that. The same 2. So ladies and gentlemen, of course, nobody will tell you to derive all this. If you tell me to make use of the PE ratio to value an organization, if you tell me to make use of the PE ratio to value, I'll just come and remember that PE ratio equals MPS all over EPS. And because they want me to value the firm, I'll have to make the market price per share the subject, which will be equal to PE times EPS, So in terms of totality, it will be total market value will be equal to PE, will remain the same, times now total earnings, So the PE ratio has been given as 8 times the total earnings that we envisage to realize as a firm. And if you go to the beginning of the question, they have told us Huge Limited intends to take over Tiny Limited, another company in the same industry. Tiny Limited is expected to post earnings of how much? 86. Is expected to post earnings of 86. So 8 times 86 gives us how much? Somebody. So 8 times 86, that gives us how much? Somebody? 688. Now, I would want to know whether all of us now are comfortable in terms of corporate valuation using the PE ratio. Are we now okay? Especially for the students who said that are a little bit of ish on this area. So now somebody says yes. The students, especially the ones who told us to repeat this, are they now comfortable? Because we are here for you. Doreen now says yes. I'm waiting for the last 2 yeses before I pull the next trigger so you can put Kasnep down. All of us with all this train, understood. Thank you and thank you very much. Now, ladies and gentlemen, I would want you to play the ball for Roman 2. Roman 2, they want us to do something very easy. They want us to give them the WACC. So Roman 2 is purely your work. Roman 2, I'm giving you 5 minutes. That is purely your job. Roman 2 is purely your job. The first thing that I will do is to come and give my examiner the cost of equity. So let's give our examiner the cost of equity using CAPM. The other sitting, they asked us to give them 4 functions of CAPM, uses of CAPM. One of the major uses of CAPM, ladies and gentlemen, is to ascertain the cost of equity. One of the biggest uses of CAPM is the ascertainment of cost of equity. And to get cost of equity, to get CAPM's cost of equity, we'll take risk-free into ERM minus risk-free multiplied by beta equity. So the risk-free, what do we have here as our risk-free? If you look at this question just before the required, you'll be able to see that our risk-free rate of return is 6% plus into brackets market returns. Market returns again in this sentence just before required. Just before required, you'll be able to see the market return is 11% minus 6% multiplied by our beta. Beta up there has been given as 1.6. Now here you have to move very slowly for you to be able to appreciate, body mass. And if I'm the one doing this, what I will do, I'll pick it from the brackets first. I'll talk of 11 minus 6 equals whatever I get. I multiply by 1.6 equals plus 6, plus 6, plus 6. Somebody give me an answer there. Someone give me an answer. So they're giving me an answer of what here? 14%. After I get the cost of equity, now I have to incorporate debt into this equity for me to be able to get a composite cost of capital. A composite cost of capital is our WACC, which will be equal to weight of equity, cost of equity, plus weight of debt, cost of debt. But remember, the debt cost is normally allowable for tax purposes. The debt, cost of debt is normally allowable for tax purposes. It's normally allowable for tax purposes. So ladies and gentlemen, if you look at this thing very well, already we have the weight of debt from the gearing. The gearing, ladies and gentlemen, gearing was 35%. Gearing was given up there as 35%, meaning that weight of debt is 35%. Weight of equity is 65%. So 0.65 times the cost of equity, which is 14%, plus weight of debt is 0.35 times cost of debt. Cost of debt has been given. They have given us cost of debt as 7.4%. Cost of debt as 7.4%. Cost of debt as 7.4% times 0.7 like that. Why 0.7? Because taxation has been given as 30%. Tax which is given there is 30%. So 1 minus 0.3, that gives me 0.what here? That gives me 0.7. That gives me 0.7 like that. So from Samuel Oyunge, they are telling me that the final answer should be 10.94%. 10.94% is what I should use. 91, let me see which one is popular. I think 10.91 is the most popular. We can even decide to make use of what here? 11% approximately. Approximately, that is 11% approximately. Approximately, that is 11%. Now from there, ladies and gentlemen, please go and pick on the next question as I fix my camera. Pick on the next question, which is Roman 3. Roman 3, or ask a question on Roman 2. Okay, so the last one, the last requirement, they want us, ladies and gentlemen, to give them the offer price for Tiny Limited, but now this time around using discounted cash flow based valuation, which is my today's concept. My today's concept that I can even guarantee you, great students of mine, you can't miss in your exam. You can't miss this kind of a concept in your exam. In your exam. Yes. So where are we? So ladies and gentlemen, here we are. The offer price for Tiny Limited using discounted cash flow based valuation. So first of all, we have to look for our cash flows. So our cash flows, I can see sales, I can see expenses, I can see interest, charges, etc., 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 etc. So the most important thing that I would want you to give me there is profit before tax. Please give me profit before taxation. Give me profit before tax. How will I get this profit before tax? Profit before depreciation and tax. Just give me profit before depreciation and taxation. So my profit here, my profit before depreciation and tax here will be equal to, we have, of course, our sales. I will subtract whatever they are calling cash expenses. I'll come and subtract interest. So when getting profit before depreciation and tax, I can't subtract capital allowance because capital allowance itself is the depreciation we are talking about. Remember I told you for capital allowance, after capital allowance, you guys were to put there in brackets depreciation, right? Also don't subtract cash to replace assets. Replacement of assets normally comes much later. Don't subtract what we call the CAPEX, capital expenditure. Don't subtract it. Great. So what we shall do, we have year 1, year 2, year 3, and then we have, yeah, those 3. So we have sales for year 1, I can see it's 200,000. Year 2, we have 280,000. Year 3, what do we have here? 320,000. Now, ladies and gentlemen, from there, we have expenses, the cash expenses. We have 120,000, 160,000, 180,000, So subtract these ones. I also have interest to be subtracted forthwith. So interest, what do we have here? 10,000, 10,000, 10,000. So if I subtract those three, then I'll be able to get what we call profit before depreciation and what here? Taxation. Profit before depreciation and taxation. Year one from Pamela, 70,000. Year two. Year two, we have 110 from Bernard, 110,000. Year three, 130,000. So come here and less depreciation very fast. Depreciation is our capital allowance. Capital allowance. So depreciation, what do we have here for depreciation? Depreciation, capital allowance 20, 30, 40. So we have 20,000, 30,000, 40,000. You subtract like that, you will be able to give us the profit before taxation. Profit before taxation. Please kindly, thank you very much for participating, giving us figures. I know how important that aspect of you giving figures to me is in terms of your career development. I know how important it is. Ladies and gentlemen, remember, there is an age. Once you cross that age, you become so busy with so many things asking for your attention, beckoning for your attention from left, right, and what here? Center. So the only way of you at least ensuring that you are focusing, the way Biguna tells us, focus, is to contribute here, And of course, if all of us were very nice in terms of muting our mics, we could be muting even our mics, all of us, and then occasionally, if you want to talk to us, you put up your hand, we unmute you, you talk to us, for you to be able even to increase your concentration. Otherwise, the moment you just sit behind back there, and then you keep on, in this case, ukiangalia left, unasikia Maria. Ukiangalia pande hii, iko mambo ya fees ya mtoto Monday, right? Utaweza kuconcentrate na kwa international disaster. So I'm being told here 50, 80, 90, 50,000, 80,000, and then 90,000, like that. Now, having gotten profit before tax, ladies and gentlemen, very fast, I know what I should do. The next thing, ladies and gentlemen, here will be to share this with the taxman. You share this with the taxman. So less taxation. Are you able to see the rate of tax? 30%. Tax is 30%, and it is paid in the same year of profits. In section 5, of course, if I am the examiner, I can't tell you that tax is paid on the same year of profits. If I am the examiner, and really I would want to throw, for example, many students out of the bus, which is going to go by the pass line, you simply tell them that tax is paid 1 year in arrears. The tax of year 1 will be paid in year 2, tax of year 2, year 3, year 3, year 4. When you tell them tax is paid 1 year in arrears, most of them normally will leave the main road and then they get into the bush, they disappear, and that is the objective of CASNEP, to ensure that as many as possible fail. So let's tax at 30%. Please give us the figures. Tax at 30%, please give us the figures. Tax at 30%, please give us the figures. 30% of 50,000 That will give us, because I know the answer, Doreen tells us 15,000. Aurelia tells us, in this case here, 15, okay, 24, and then 27. You subtract like that. And then whatever we shall get will be called a profit after taxation. 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 So could you kindly give us these figures, ladies and gentlemen? So we have from Anwamboy, 35,000, 56,000, and then lastly, year 3, we have 63,000. Thank you, and thank you very much. Now let me ask you a question. Once we get these figures, do you think that that is the end of the road? Should we start discounting these figures to get farm value? If no, please tell me what you think I should do. They're saying no. Add back, the Dida has been able to put it very clearly. Add back, the same case with Samuel, add back depreciation. So come and add back depreciation. Add back depreciation. So our depreciation amount, remember, they are here. We have 20,000. We have 30,000. We have 40,000. So please give us these figures. Give us the figures. So whatever now we shall be getting will be called cash flow. Will be called cash flow. Will be called cash flow. Cash flow. So cash flow from Bernard Kirui. The cash flow here we have of 55,000. The second one here will be 86,000. The third one will be 103,000. The cash flow, 103,000. Thank you, and thank you very much. So having done that, what do you think will be the next thing to be done? What do you think will be the next thing to be done? Discounting? Bernard tells me, discount those things. We get the cash flow for year 4 to perpetuity. Good trial. Good trial. Less replacement. Before valuation, Mary, there is replacement. We need to less replacement. We need to less replacement because you see, for farm valuation, we normally use the cash flows that are free. The cash flows that the owners of the business can get out of the business. What we call the free cash flows. Out of these cash flows we get, some of these cash flows here have to be retained by the organization for growth, future growth, further expansion. So after you get these operational cash flows, please go ahead and subtract what we call replacement cash flow. So subtract what we call the replacement cash flow. So we have here our operational cash flow. So our operational cash flow, we have 55,000, we have 86,000, we have in our case here 103,000, like that. 103,000, like that. So then, gentlemen, come and less here, less replacement cash flow. Replacement cash flow. What at times they call the CAPEX. What at times they call the CAPEX. CAPEX is capital expenditure. CAPEX is capital expenditure. Year 1, I can see 25,000. Year 1, I can see 25,000. Year 2, I can see 30,000. The capital expenditure must be retained within the organization. The capital expenditure must be retained within the organization. Must be retained within the organization for you to get what we call the free cash flows. The free, which Emma Wanjiro has been able to give them to me very well. We have 30,000. After 30,000, 30,000, 56,000, 56,000, and then the last one happens to be 68,000, 68,000. The last one happens to be 68,000, 68,000. So kwanza paka hapo tuko pamoja, tuko pamoja, si kama ile pamoja politicians leo anakuambia tuko pamoja, na kumbe they are worlds apart kabisa. Great. Now it's after you get the free cash flows, ladies and gentlemen, that now you will think about what Mary Wamboi was telling us, valuation. And for valuation, I would want to give you exactly 1 minute. You value yourselves. Try valuing this thing yourselves. So valuation. Teresa George is asking, why less replacement at the end? I started by telling you, ladies and gentlemen, that at the end of the day, after you generate your cash flows, it is not all those cash flows that will be available to the shareholders for taking out of the farm. After we get our cash flows at the end of the day, we need to retain some money to buy assets, to replace the assets which were used to generate these cash flows here. So then what we need to do is to come under less the replacement cash flow. So we can get now what we call like dividends to get the free, because when valuing organizations, in situations where replacement costs are given, you have to subtract the replacement costs for you to be able to get what we call the free cash flow. Free cash flow. So Teresa, I hope that is okay. So I'm giving you exactly. Doreen asks, why did we add back depreciation? Remember the concept of depreciation. Depreciation is a non-cash item. Non-cash item. Once you get your profit after tax, you must add all the non-cash items for you to get cash flow. Cash flow. So you add back all the non-cash items, which are depreciation, amortization, etc. You add back the non-cash items. Great. So I'm waiting to see students who will be able to do the evaluation very fast. The evaluation is very fast. The evaluation is very fast. Okay, finished. Value of the farm. Jairus anauliza mwalimu aliuliza nini? Simple question, value of the farm. Good questions. Now, ladies and gentlemen, what have they told us here? What have they told us here? So they've told us something very nice. This paragraph immediate paragraph coming after the table. From year 4 onwards, it is expected that the annual cash flows from Tiny Limited will increase by 4% each year into perpetuity. Perpetuity is the same as what here? Infinity. Perpetuity is the same as infinity. So then what we will do is to have you, I'm the one doing this, I'll come and talk of valuation of the farm. So we have year 1, year 2, year 3, and then we have infinity. So year 1, we have 30,000 value, not value, but cash flow. Year 1 cash flow is 30,000. Year 2, 56,000. Year 3, 68,000. And then infinity cash flow, we need to look for it. The infinity cash flow, that has to be you and me, yours and mine. Remember, infinity cash flow, whenever I hear of this word infinity cash flow, I know at the end of the day, I have to use the provincial officer formula. I must make use of the provincial officer formula. I know provincial officer is district officer. District officer is much lower in terms of rank. So the district officer has to grow to be able to match this guy, 1 plus G. Otherwise, without the 2, it will be Kenya minus government. Kenya minus government. Now, ladies and gentlemen, remember, here I'll have to come and use what we call the PVIF. And this PVIF, I will be discounting these figures using 11%. Using 11%, the one that we got up there. 11%, the one that we got up there. So my most current dividend cash flow is 68,000 into 1 plus the growth rate. They told us the growth rate into perpetuity. They gave us a growth rate of 4%. A growth rate of 4%. So 0.04 into here. Please never ever get confused. The figure that you shall use here for discounting is the figure you will use here. So don't get confused here that should I use KE or WA? No. The figure that I'll use here for discounting 11% is the one that will be used for discounting this perpetual cash flow. So here, make use of 0.11 minus 0.04, like that. So could you kindly give me an answer here? Kindly give me an answer. Is it 11 or 14? The WACC. The WACC. The WACC. Now, I've understood what they're talking about. I've understood why they're asking that question. Ladies and gentlemen, listen and listen to me very well. Remember what have I said? Here, this is simply a formula that I coined for you to be able to appreciate the formula of infinity. The formula of infinity. Ladies and gentlemen, don't take this blindly and work with 14% here. Remember here, what are we doing? We are discounting the future cash flow. And the discounting percentage has to be the same. Has to be the same. So here we are making use of 11% WACC because, after all, the cash flow that we have here is a cash flow which is covering both debt and equity. So this one here should be what? WACC, because you're using WACC here. So this one basically should be W. Thank you very much for asking that question. WACC. So could you kindly give me this answer now? Remember, for Mwalimu is only looking for how many areas? Like say 5 areas. Those areas that I know if I ensure that everybody is good at them, we are going to survive, all of us. And that is the objective. We pass. We don't want to really, even God can't allow this, that we study. We study these single subjects a whole year and then we fail. No, no. So I'm being given a figure here, 1010, 285, 1010, 285, 1010, 285, 1010, 285. That's okay. Now, please give me these PVs at 11%. Give me the PVs at 11%. Give me the PVs at 11%. Please give me the PVs at 11%. Remember, our formula is quite easy. Our formula of getting PVs is 1 plus R raised to negative n. So it will be 1.11 raised to minus 1. 1.11 because our cost of capital is 11%. Because our cost of capital is 11%. Our cost of capital is 11%. So P Njenga gives me 0.9009. The second one, 1.11 raised to minus 2. 1.11 raised to minus 2. Somebody tells me Jadida 0.8116. 0.8116. The last one, the third one, 1.11 raised to minus 3. We have 0.73. 12. From Bernard. How about the infinity one? How about the infinity one? Virginia has also given me a figure. Bernard again has given me a figure there. We have Vivian telling me, Mwalimu, use for infinity, use the discounting factor of year 3. For year 3, 0.7312. And that is it really. So our work in terms of 2 decimal places is to come and ascertain the present values. We ascertain the present values. So present values, you are taking this times this, give me 2 decimal places, I write. Give me 2 decimal places, I write. Give me 2 decimal places, I write. 2 decimal places only. 2 decimal places, 30,000 times 27, 027. 027. Great. How about the second one? Sukari imeanza kuteremka chini kwa mwili kijikaze. The second one from Eva is 45,449. 45,449.6. How about the third one? The third figure. I'm waiting for the third figure. 49,721. 49,7. Oh, those are too many. 49,721. 721.6. Lastly, is this humongous figure. 738, 712, 738, 712.21. So then if that is the case, could you kindly come and add up? Kindly come and add up for you to be able to give us the total present value. Kindly add up for you to give us the total present value. So the total present value will be our farm value. The total present value will be our farm value. Total present value will be our farm value. So according to Josam, 860, 919. Now, how many of us would have gotten this question right? The whole of it. How many of us would have gotten this question right? The whole of it by a show of hands. A show of hands. By a show of hands. 860, 919. A show of hands. There is a place there where you can use. You can decide to use this. I can see Zoom is improving day by day. They're also coming up with emoticons, emojis. Initially, they used to have only the claps, but now I can see they have brought these emojis. For example, now you can say you are very happy, right? You can come and say this question, I'm sad. Yeah, you should know how to use these things. You can come and say, I love this question, right? Right, like that. You can even celebrate like that. Yeah. Now, a student is asking, what happens to the 4% in the third paragraph? The 4%, we used it. This perpetual cash flow. When we if you recall very well, perhaps I moved with speed. If you can recall, we said here, PO equals who? PO equals who? DO into 1 plus growth rate. If you look at this G, that G is where we used the 4%. 4%, which is 0.04. It was used when computing the perpetuity. Great. Now I want to go to something different. Is the growth rate? Yes, thank you very much. So I want to go to something different, but before I go to something different, because I'll never do this concept again. I will never do it again. I'll never do it again, but for sure, you're going to get this in your exams, for sure. For sure. For those of you that have ever taught before, mnajua mwalimu ni live wire. Unarudia maswali ambayo anakufunza, utapata yote kwa exam. And I told you I'm not an examiner, only that I get to study the same books which examiners at times study. Yeah. If you look at May 2019, question number 5. May 2019, question number 5. Doreen, just check that PO well. I'm so sure, Doreen, here, you must have used this 14% instead of 11%. Doreen, you must have used 14% instead of what here? 11%. The DO, yeah, DO is 68. DO is 68. Just check again. Okay. So for this May 2019, I don't want you to do so much. I would want you to go and do this question later. But most importantly, look at the requirement. Required, they want us to determine the maximum price payable to acquire Best Limited using the discounted free cash flow basis. Free cash flow basis. It's May 2019, question number 5. I think Mary does not have this question. There is a student who can take a snapshot of the question and throw it to WhatsApp. You can even see her number there. You can even see her number, mobile phone number is there. Somebody can even decide to send her the question directly. So for me, what I would want you to do for me for tonight is to ascertain the free cash flows out of this question. If you can get the free cash flows out of this question, Mwalimu will be very happy. May 2019, question number 5. Remember, all these sittings, by the way, CASNEB has provided the questions of these sittings. on their portal. They have, if you Google, you'll get all those questions. So May 2019, question number 5, and I'm expecting a good Samaritan by now should have sent this question to someone's WhatsApp group, even to our WhatsApp group, where people will be able to get them. Also here, if you have a good camera, after you take the photo, you can also try to attach it here. There's a place where you can see the file. Just attach it here, and then somebody will be able to pick it. So what are we calculating? What we are calculating is the free cash flows. The cash flows that we shall use for purposes of valuing this particular farm. Thank you. Okay, finished? So I'm waiting to see the answers. I'm waiting to see the answers. I am waiting to see the answers. So it's May 2019, question number 5. May 2019, question number 5. Cost of equity is 12%. She's been able to use CAPM. But remember, what I wanted you to already to give me are the free cash flows. You're going to give me the free cash flows very fast. I'll sleep tonight, a happy man. The free cash flows. Take those net sales, you subtract all the expenses. Okay, like now what do I have here? Very easy question. So I have my sales. I have my sales here. So the sales that I have here, we have 1, 2, 3, 4. 1, 2, 3, 4. And then we have the 50 here. So I can see here, we have 50, 60, 75, 70. And then lastly, we have 65. So I can see expenses there. I can see operating expenses. So operating expenses, we have 5, 10, 15, 12. Ladies and gentlemen, I also have selling and administration. Selling and administration. So selling and administration, we have 10, 8. We have 9, 11. Ladies and gentlemen, acceptable investment projects, those are replacement. Those are replacement, and replacement will factor them in much later. Replacement will come in much later. Now, ladies and gentlemen, the next thing, read the additional information. The risk-free rate of return is 8% and debt is considered to be risk-free. Great, but that will be used much later. Expected return on the market portfolio is 13%. That is CAPM concept later. The firm's levered equity beta after acquisition is estimated to be 0.8, later again in CAPM. After 5 years, the net cash flows of Best Limited shall increase at a constant rate of 6% per annum in perpetuity. I'll be able to value the perpetuity. Corporation tax rate later. And then they have given me the firm's gross profit margin is 40%. So when you see the gross profit margin being given, then there must be cost of sales. This one confused so many students. When you see gross profit margin being 40%, it means that the cost of sales will be 60% of the sales. So anytime you're given the gross profit margin, there must be a cost of sale. There must be a cost of sale. So could you kindly give me this cost of sales, which are 60% of 50, like that? Kindly give me the answers very fast. Remember, this is supposed to be your board. Not my ball. Not my ball. Mine is to capture all the expenses. So we have here 60%. The first one I'm being told is 30. 36. I'm being told 45 by Virginia. Next one is 42. Next one is 49. Oh, 49 or 39. Great, great. So please continue like that. Okay. So we are told there 7, Best Limited incurs fixed financing costs of 2 million per annum, of 2 million per annum, 2 million per annum. So financing, that is interest. 2. So please subtract for you to give us the profit before tax. Profit before taxation, being given by Emma here, a figure of 3. A figure of 3. A figure of 3. Emma is giving me a figure of 3. 2. But these are your figures, not my figures. 5, Bernard. Bernard gives me another one of 2. The last one. Bernard gives me 1. The last one is 1. After getting profit before tax, you need to come here very fast and subtract tax. So you less tax. At what rate? The rate, of course, has been given there as 30%. So tax at 30%. Tax at 30%. So 30% from Emma, I can see 0.9. 0.9. 0.9. 0.6. 0.6. We have 1.5. Thank you. 0.6 again. 0.3. Thank you, and thank you very much. So please subtract these ones very first. Very first. When you subtract them, what are we seeing here to be our profit after taxation? Profit after taxation, Virginia has every, no. 2.1 Emma. Emma gives me 1.4 again. 3.5. 1.4. 0.7, the last one, 0.7. Now, ladies and gentlemen, listen and listen to me very well. If I had any depreciation, if I had depreciation in the question, I would have said add back depreciation. But here depreciation is nowhere to be seen. And the 20% in the first paragraph, let me see. Excellent Limited is considering acquiring Best Limited, a firm in the same industry, in order to consolidate its market share. Best Limited has been less profitable, so it has paid an average of only 20% in taxes during the last several years. Historical tax. Historical tax. Right? So we continue. In addition, it has used little debt, having a debt ratio of 25%. If the acquisition would be implemented, Excellent Limited could operate Best Limited as a separate, wholly owned subsidiary. This will increase Excellent Limited's gearing to 40%. So you can see they're giving us very nice things there. But look at note number 5. Corporation tax rate for our analysis moving forward should be 30%. Whatever you have up there, taxes, that was historical. That was very much historical. That was very much historical. That was very much historical. Please ask questions. It's important we get their questions. Why is interest 2? Let me see. Why is interest 2? Because of note number 7. Note number 7, best limited in cars, fixed financing cost. You see, financing cost is interest. Fixed financing cost of 2 million per annum. Our figures are in millions. That's why we have our financing being what here? Being 2. I hope I've answered you, Susan. I hope I have answered you, Susan. True or false? Thank you, great. Thank you very much. So I was trying to explain a point here that if we had our depreciation, we would have added back depreciation here to get cash flows. But you see here, we do not have depreciation in this question. So whatever you have here is your cash flow. The only thing that you need to do is to come and remove the replacement costs. So from whatever you have here as profit after taxation, what we are calling the cash flow, year 1 is 2.1, 1.4, 3.5, 1.4, 0.7. So once I have that, I will come here and less what we call capital expenses, CAPEX. You less the CAPEX, capital expenses, which is the same as what here? Replacement of assets. Replacement of assets. So replacement of assets, year 1, they have given us a figure. Acceptable investment project costs, we have 0.5, 0.7, 1.6. After this, we have 1.2, and then we have 0.20, like that. Now you come and subtract these ones, you subtract them for you to be able to give us, subtract them, for you to be able to give us what we call the free. We are free now. The free cash flows, which you shall be using for purpose of valuation, of which somebody has been able to give me all the figures. There's a good student here who has been able to give me all the figures, actually 2 of them. So we have 1.6, 0.7. Yes. We have 1.9, 1.9. We have 0.2. We have 0.5. Now, ladies and gentlemen, after we get these free cash flows, we know that the next thing now should be all about valuation. Lakini kabla naenda valuation, kuna ile jembe. Kuna jembe zangu nahitaji. Nitahitaji WACC. Nitahitaji WACC in this question. To get WACC, I need the weights. So I want to give you just 1 minute, only 1 minute. You give me the WACC for this question. Only 1 minute, give me the WACC. So to get WACC, first of all, I'll get cost of equity using CAPM. Using CAPM. So using CAPM. Very good. Malim says CAPM. I like that argument. That's a student who has understood. CAPM, next WACC. Thank you very much. Apply CAPM, and then the next thing will be WACC, yes. So I'm waiting for the answers. Kindly Kindly, I'm waiting for the answers. Virginia tells me the WACC is supposed to be 12%. WACC is, are you sure? I think what you're getting there is cost of equity. Cost of equity. So if Mararo tells us CAPM, great. So CAPM, thank you very much. Thank you very much. So CAPM, what do we have here for CAPM? What do we have here for CAPM? Ladies and gentlemen, for CAPM, this is what I have. For CAPM, cost of equity, CAPM, cost of equity, we know it is risk-free plus ERM minus risk-free multiplied by beta equity. Risk-free, which also happens to be cost of debt, has been provided in the question. They told us the risk-free is 8%. Risk-free is 8%. Market returns also have been given to us. We've been given note number 2. Expected return of the market portfolio is 13%. So we have here 13% minus risk-free, which is 8%, multiplied by beta equity. This beta equity, ladies and gentlemen, has been provided. The beta equity has been provided. Note 3. The firm's levered equity beta is 0.8. 0.8. And there are students who have been able to do this, and they're giving us what percentage they are? They're giving us 12% exactly for cost of equity. So having gotten cost of equity, I hope we are together. Having gotten cost of equity, now I will be able to give them the W what here? The WACC. Now I will be able to give them the WACC. So how do I get WACC? That is the most simplest thing that we can talk about on earth. To get WACC, ladies and gentlemen, WACC, we normally talk of WEKESA into 1 minus tax. Into 1 minus tax. And then, ladies and gentlemen, remember the weights have been given. The weights have been given. There is a place where they gave us the gearing ratio of 40%. Whenever you hear of gearing ratio, straight away you know that gearing ratio is the same as weight of debt. So weight of debt is 0.4. And then weight of equity will be 0.6 times cost of equity. You guys gave me 12%. Cost of debt, these guys spoke about the cost of debt being exactly equal to risk-free rate of return. Cost of debt is the same as risk-free rate of return. Ladies and gentlemen, multiplied by 1 minus taxation. 1 minus taxation, tax is 0.3. So 1 minus 0.3 gives us 0.7, like that. So then could you kindly give me the final answer? Kindly give me the final answer. Kindly give me the final answer. So Bernard tells me 9.44, 9.4 Aurelia. So 9.44 is very, very correct. If I'm the one doing this, I'll come and say 9%. We shall make use of 9% as our discounting rate. Thank you, and thank you very much. Now, the only thing that I need to do now ni kuje hapa nisimamishe hizi cash flows kwenda chini. Sasa ndio naweza kuvalue vizuri, nisimamishe kwenda chini. Namna hii woye finance AFM is the best subject in CPA for the papers that I teach. So we have 1, 2, 3, 4, 5, and then we have infinity. Don't forget that there is infinity in this question. So year 1, the free cash flow is 1.6, 0.7, 1.9, 0.2, 0.5. Infinity cash flow, we have to look for it. And remember, in infinity cash flow, what I will do, I'll need to know what I'm going to use to discount. Present value interest factor at 9%. So then this one will be 0.5 times 1 plus the perpetual growth rate. The perpetual growth rate the perpetuity growth rate. They have told us in note number 4, after 5 years, the net cash flows of Best Limited shall increase at a constant rate of 6%, the perpetual. Thank you very much, Bernard Kirui. 6%, 6%. So we have here plus 0.06 close all over the percentage that you have here. Whatever you have there, 0.0, 0.09 minus 0.06 like that. And then you give us a figure. Remember, it is the most current dividend, most current cash flow times 1 plus growth rate all over cost of capital that you are using there minus the growth rate again, 0.06. So we want to see whether there is any student who will be able to give us this answer very fast before we disappear. Time is not on our side. 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 So Bernard tells us that the entire thing here is supposed to be 17.7. %. Why 8%, Malim? Why 8%, Malim? 17.7, eh? So this one I'm being told is 17.7. 17.7. Now at the lightning speed, could you kindly give me these discounting factors? At the lightning speed, kindly give me the discounting factors at lightning speed. Remember, our formula for discounting is 1 plus R raised to negative n. So it will be 1.09. 1.09 raised to negative 1. Like I can see somebody giving me 0.9174. 0.9174. Thank you. 0.8417. I'm waiting for the others. I'm waiting for the third one. I'm waiting for the third one. I'm waiting for 0.7722. 0.7722. Ile nguvu ya mwisho kabisa jameni. Najua kuna mtu amekimbia sana. Paka maybe sikio moja ikaziba. Paka sikio moja ikaziba, lakini ile dakika ya mwisho unajikaza. Dakika ya mwisho unajikaza kabisa. 0.7084. Thank you very much, Daniel, for coming in. 0.7084. How about the other students? The other 0.6499. I'm so sure the last one for infinity, most of us will not be able to get it right. For infinity, most of us will not be able to get it right. What do we have there? The last one, the last one, the last one, the last one, the last one. I'm waiting. The last one is equivalent to the second last. Always 64.99. The ladies and gentlemen have infinity 0.6499. Ladies and gentlemen, having done exactly that, let's take the last step. The last step before we hit the closing line, closing line, let's have here the present values in terms of 2 decimal places. In terms of 2 decimal places. So what do we have here? 1.6 times 0.9174. You give me a figure. We move on like that. Give me a figure. Give me a figure. Give me a figure. So the first one, I'm being given a figure of 1.47 by Jadida. By Jadida. How about the next one? I'm being given 0.59 by Kirui. 0.59 by Kirui. Aha, we are almost there. We are almost there, ladies and gentlemen. Ladies and gentlemen, we are almost there. 1.47. 1.47. 0.14, 11 point last. Thank you for specifying. 11.4. Thanks for specifying. So the second last will be 0.32. 0.32. So now come and add. Once you add there, that will be everything. You'll have gotten the total present value. You'll have gotten the total present value. So please give us the total present value inakuja ngapi? Total present value, which is the same as value of the firm, which is the same as value of the firm, value of the firm, which is the same as value of the firm. According to Bernard, 15.54. According to Aurelia, 15.49. According to Maalim, 15.5. So all of you are correct. The difference is rounding off errors. But I can see 15.49 being spoken about by so many students. So the total present value is the value of that farm. So there is no way I will pay for this farm more than 15.49 million. 15.49 million Kenya shillings. Ladies and gentlemen, that is it. Next time when we meet, we shall be going to the other type of question that Mwalimu suspects. Remember, it's about suspicion. I'm not so sure. This concept of real options. The real options, if you can remember Black-Scholes model, P1 equals ln P over E. Those are the kind of things we shall be doing because Mwalimu thinks that they shall be there. Your work as you go to sleep, as you start, of course, next week, think about marketing Mwalimu's crash program. I need to go back to where I used to be. 80, 90 students, that's where I need to go back to. That is my position. My position is not below average. Below 50 is below average. Do we have a class tomorrow? Sawa sawa, that I'll be able to share. Do we have a class tomorrow? Unfortunately, no. Our classes have been reduced to how many? 2 classes, Thursdays and Saturdays. Thursdays and Saturdays. Thank you very much, Boniface. We shall overcome. SG, of course, tomorrow we have SG double from 8:30 to 1. And we shall be doing 3 case questions. 3 case questions. You need to join us. SG tomorrow from 8:30 to 1. 8:30 to 1. SG is another subject which gives students a lot of problems, and yet it is the easiest subject in CPA. Ile subject ambayo unafaa ufanya kama umefunga match, because all questions, like now the case questions, where do they zero in? Things of what your corporate governance. Is this firm run very well? The chairman and the CEO are the same. Poor governance. Questions on morality, like what we call the Kohlberg stages of moral development. Very popular in your case questions. Once you have like 3 scenarios of those case questions, then you should be able to pass SG really without a lot of what here struggle. So it's 8:30 tomorrow to 1. So thank you very much. Any other question? There being no question, and of course, having had a marathon class, I beg to end the class here. It has been a pleasure hosting you tonight.